times that I've been coming in to talk to the network, it's been very much about economic fundamentals and why we believe over the medium term uranium has to move. I think you're going to detect from this presentation, it's a now story, it's an imminent story, and we're more talking about weeks rather than months and years for a correction in the sector. Okay, so just a quick recap on Bannerman. We've got the Etango project in Namibia, 95% owned. It's a very, very big project, 271 million pounds of resource. It's advanced, it's unaligned, and it offers exceptional valuation leverage, as we'll hear. Market cap sitting at about 40 million Australian, and that compares with 80 million that we've spent just in the ground. That's drilling and engineering, basically. So we can double, and we still haven't passed go from where we are. Strong register, strong board. We don't have any debt, and as at the end of March, we had 1.3 million in cash. Off a fairly modest burn, I might add. Now, if we look at what are the fundamentals that are driving increasing excitement in the uranium sector, first of all, we're moving from a decade-long surplus and swinging into deficit. And as you'll see from this presentation, it looks like 2018 will swing quite widely into deficit. Now, secondly, in the next 3 months, so in the next 6 to 12 weeks, we've got a number of significant supply disruptions that together can aggregate for more than 20% of the market. So a very deep swing from surplus to deficit. Against that background, we've got a number of factors that are leading indicators of increasing demand. We know that the uranium sector is highly responsive to catalysts, so we've got a number of investors sitting back waiting for that and waiting for the excitement. And what's particularly interesting about where we are at the moment is when you look at the spot price and the fact that it's barely moved in the last few weeks, we've got a level of spot price inertia, and that lack of response is going to generate price volatility, which is a great proposition for equity investors, particularly in a stock like Bannerman. Now, the thing is, we've still got an enormous amount of uncontracted demand over the next 10 years in the sector. That hasn't changed, despite the supply picture changing, the demand picture growing, and the inertia price response. So in summary, although spot prices and equities are at lows, we've got a correction pending in the short term, which presents the equities opportunity. So there it is. That is the picture of a big, solid, long, horrible bear market swinging into bull. And if you look to the last time we had a switch from surpluses in the sector in black to deficits in the sector in red, that was the price response. And interestingly, from levels that are where we are now. So from $21 a pound as the sector last switched in 2004 through to a top of $136 a pound before the GFC started to affect financing and other areas in the sector. And we've seen the price come down steadily, but clearly not quickly enough. And we finally had 2 years now of devastating prices that are bringing on the type of supply response that I'm talking about in a moment. On the blue there, on the axis, is current mine production plus net secondary supply. And you can just see a faint blue line at the top there, which is 2017 reactor consumption. So for 2017, you can see that that reactor consumption is a little bit lower than the total supply, and that's the nature of the surplus that we had last year. The waterfall diagram and these orange bars represent supply disruption that I believe is likely in the next 6 to 12 weeks. The biggest one there is Macarthur River. It is the world's largest uranium mine. It's the flagship of the Cameco organisation, and its current status is a temporary production stoppage for 10 months, and that will finish at the end of the year. Now, the reason it's temporary and the reason it's only 10 months is there's an industrial relations provision in North America which enables Cameco to send their employees home and ask them to sit there for 12 months in exchange for getting 75% of their salary. So it's a hard decision, but it's a relatively soft decision for Cameco to make. But you can only do it once. So in the next 6 to 12 weeks, they need to make the decision whether they ask everyone to come back to work or whether they put that mine onto care and maintenance. And I believe it's highly likely that they'll be forced to put that mine onto care and maintenance. But here's the thing, the nuclear utilities and most of the supply models that you're seeing out there, they can't make that assumption. They can't use the judgment that I can use from where I am. So the assumption is that they will ask everyone to come back to work. So that's why I'm treating it as a supply disruption. Langer Heinrich is the next one, £4.5 million. We've already seen that confirmed in the last week. The next one's DOE Barter. That's the Department of Energy secondary sales program in the US. That's one Senate committee decision away from being suspended for the next fiscal year. The next one is Cameco purchases. Now, I've treated that separately from Macarthur River, and that's because Cameco in their last quarterly announced a uranium loan of £5 million to Urano. Urano is their joint venture partner in Macarthur River, and it used to be called Areva. So they've committed to loan that uranium to Urano, and it'll be repaid from future Macarthur River production, 2021 or later. And they will go into the market to buy that out of spot. I've put in £5 million there. There's a number of commentators saying that Cameco spot purchases in the next 12 months will be 10 to 15 million pounds. So there's a bit of upside there. The next one's very interesting. It's physical fund purchases. So some of you will be familiar with Uranium Participation Corp. That is a physical fund that raises money from investors and holds uranium and US6 on converter accounts in conversion facilities around the world. The reason that they exist is, unlike gold, for example, you can't just go and buy physical uranium and put it in the safe and save it for the grandchildren. So the only way that investors can get physical look-through access to uranium is through UPC, which trades on North America. We've seen in the last 6 months a number of UPC lookalikes engaged in various levels of pre-marketing, and there's one that I believe is very soon to lodge a prospectus to raise on AIM, to give the London market access to a physical exposure to uranium. And I think in the next 12 months, we'll see those physical funds absorb between 5 and 10 million pounds of 2018 production from the market. So stay tuned. The moment that that prospectus gets lodged, I'll drop a note out through my database. So if you're not on that email distribution list, send me the details. I'll send it through to Sam Turner and I'll make sure that you're on that. And then finally, there's a number of other production reductions that have already occurred versus 2017 that add to about £5 million. That's predominantly the US, Niger and elsewhere. So here's the thing, you add up those likely production disruptions, and that is 20% of a market that tends to be pretty finely balanced. And that is a very, very significant supply response. On top of that, we've got two wildcards. One is Kazatomprom, and you would have seen that towards the end of last year, they announced a 20% reduction from planned production, which was escalating. So it's a modest production cut. But President Nazarbayev from Kazakhstan has just approved the IPO. And so I would regard there being a number of potential catalysts that we could see Kazatomprom drop into the mix if we don't see the spot price move to levels that makes that company profitable ahead of its IPO. And they have also established trading house Kazakhstan. It's now got a CEO. We understand it's got a pathway to funding. And so exactly what their next move is, we're not sure, but it sits out there as a wild card that could further take pounds off the market. Against that backdrop, we've got a number of indicators of demand growth building in the nuclear sector. And what I'd like you to do as I put up these a series of charts here is just look at 2017 versus what we're expecting the next few years. Because 2017 was the year in which the bears in uranium and bearish commentators were able to start claiming that they were right. And when you see these numbers, you'll understand why, but you'll also see why, with a little bit of an eye on forward indicators rather than real-time indicators, we're seeing that momentum coming back in. So first of all, nuclear reactor completion. So these are connections to the grid. On the left, that is the 25-year average until 2015, and that was 5 reactors connected every year. We had a good year in 2015 with 10 reactors connected, half in China. Another good year in 2016 with 10 reactors, half in China. And then in 2017, we only had 4 reactors turn onto the grid. Now, the reason for that is most of them fell just the other side of the year into 2018. So we're expecting to see 14 reactors in 2018 and even more in 2019. So very strong demand growth hitting the mark in nuclear power. There's still 58 reactors under construction, 20 of which are in China. So that is a very significant number of reactors to turn on in the next 3, 4, 5 years. And importantly, there's 154 reactors that are either on order with the big vendors around the world or planned. And planned doesn't just mean, it'd be a really good idea to increase the reactors at that plant or add one. Planned means you've got an approved site and you've either got approved finance or a sovereign deal. So it's a high level of planning. It's just that perhaps they haven't started turning concrete yet, or perhaps they haven't got the timing quite locked in as to when they want to come on. We're finally starting to see momentum build amongst the Japanese reactors. So again, 2017, there weren't any new reactors turned on in Japan. But we've already had another 4 turn on this year, and it looks like we'll finish the year with either 9 or 10 reactors operating in Japan. So that's a big turnaround from none in 2014. It isn't a big demand driver, but it is a big sentiment driver, so it's well worth watching. And here are the ones that really count. First of all, reactor construction starts in China. Last year there was only 1 new reactor in China. And there are a number of commentators who were gleefully claiming that, well, renewables had won over in China, they turned their back on nuclear, etc., etc. And I'm on various recordings in Morgan's and on record in my blogs as saying that's hogwash. The Chinese are taking a pause because they don't want to approve any foreign reactor technologies when their indigenous technology is literally just around the corner. And so now we're seeing that unfold. So the Chinese government has said they want to see between 6 and 8 reactors start construction this year with an upward trajectory, as you can see from that slide. And then the other key forward indicator is reactor approvals. The Chinese government want to approve 6 to 8 new reactors for future construction this year. And that's after this hiatus that I've referred to in 2016 and 2017. That is very important given the previous slides that really show how much of a demand generator China is for this sector. So that's all pretty positive, but here's the thing. The utilities are not watching this data. The buyers in our sector are not watching the data. They're just responding to the immediate information that's right in front of them. And as the penny starts to drop, which is likely to coincide with people needing to look harder at it because of supply disruption, I'm expecting to see quite an abrupt change in the procurement profiles and risk management profiles of the nuclear utilities around the world as they start to see that there is a huge amount of appetite that's coming at them from new markets over the next 5 to 10 years. So equities investors love the concept of a uranium bull market because it's hugely volatile, and equities have been hugely volatile. But it's also very responsive to catalysts. So this chart shows the real uranium price, so the uranium price in real terms. You can see 2007, which a lot of people across the network will remember fondly, when uranium got to $136 a pound, slightly higher than that in real terms. But the last time we had a structurally driven boom in the uranium sector, as you can see, we spent more than 4 years with a real price above $140 a pound. And it took 3 Mile Island and all of the associated negative PR with that to bring that market back down. So it was the oil crisis that started that. There's economists who are drawing parallels between the oil crisis and carbon economics and climate change policies. They both affect every facet of energy. They have huge political ramifications, and they both affected pretty much every country in the world. This big trough was caused by the collapse of the Soviet Union. So a lot of weapons-grade material came onto the market and effectively flooded the market with supply until 2013. The last bull market was caused, ironically, by Macarthur River, the same supply disruption that I think is going to start this bull market. We had Cigar Lake, which is another mine with problems, and then the GFC, as I referred to before, brought the party to a close. And as it was warming up again, we unfortunately had Fukushima. So there we sit today, the initial Macarthur River suspension, the temporary suspension on that graph, and I believe in the next 6 to 12 weeks we will see that move into more of a permanent care and maintenance. So I referred to the price inertia at the beginning. So what we've got is a situation, and I'll cover this quickly, we can come back to it during Q&A. There's a thing called the Section 232 petition in the US, which is the two largest US uranium producers trying to bring on some tariff protection or other type of protection for their domestic industry. That started in January and still hasn't been progressed or resolved. The US utilities' response was to hunker down and negotiate, and part of that was to suspend their procurement process. So they've now painted themselves into a corner where they can't back down on that, but yet we're starting to see these supply disruptions unfold. And so what happens is when we're staring at these reasonably assured supply disruptions, but a sector where the buyers are not prepared to enter the market to respond in the immediate term, we see a very interesting level of price inertia. And what that is doing is it's taking what would otherwise be fairly temporary production stoppages and embedding them or baking them in as systemic supply cuts. So rather than Macarthur River being off for 10 months, seeing Cameco engender a more balanced market, there hasn't been a price response because a couple of weeks after that announcement, the Section 232 petition was lodged in the US, and so now Cameco is being forced to take a 10-month production suspension and turn it into care and maintenance, which is going to last at least 2 or 3 years. And there's a range of other mines, and some of the older mines, if Kazatomprom turns off an older mine, we won't see it come back on. Langer Heinrich's going to be off for a couple of years. If some of the other more expensive mines go off, again, we won't see them come back on. And as I said before, that's still in the context of a wall of uncovered or uncontracted demand, which totals £665 million between now and 2027. And that demand starts to really ramp up in 2020 and becomes quite critical from 2021. In the red is term contracting volumes. And again, going back to the last time we saw the sector switch from surplus to deficit, the response of the utilities was to try and risk mitigate by covering their forward demand requirements. And again, that led to a spectacular rise in uranium prices. So the message here is we might not see the spot price move in the next few weeks in response to this supply, or we might not see it normalise or equalise the market, but the supply disruption plus price inertia or no price response necessarily leads to sudden and severe volatility, which I think for equities investors is what they're looking to the most in the uranium sector. So if you accept for a moment, and most of the people I've been talking to over the last couple of days do, that we are basically on the eve of a new uranium bull market, and there's a damn good chance it's going to be spectacular like last time. And I really think that that's the territory that we've headed into. So if you accept we're on the eve of a uranium bull market, how do you play it? how do you pick the best horse in the race? How do you put your clients into a stock or a couple of stocks that are going to outperform the market and lead to the sort of spectacular equities returns that we saw from 2005 to 2007. So I've done a bit of work on this, and I've scoped out the thoughts of others, and I reckon that there are basically 6 principles that you can work with. And if anyone wants to add one or debate them, I'd actually be really interested, because this is more of a fundamental investment theory level. So I would say their track record in the sector. So if you look to lithium, when the lithium boom started, there was about a dozen lithium companies, and now there's, what is there, Sam, 500 maybe? Heaps. On listed exchanges, and that's what uranium was. And now we're back to the dozen. So you want a company that's got genuine track record in the sector. You certainly want to obtain leverage to price. If price goes up 3 times, you want to be in a stock that's going up in a leveraged fashion for that. Strategic appeal means that your investment will have lift under its wings once the correction has come and once we've seen a sustainable price, because we know from other sectors, and we certainly can predict in uranium, that it'll bring on a wave of consolidations, and you want to be one of the most appealing of those potential initiators or targets in a consolidation round. I would advocate that for uranium, you're looking for an advanced asset, and the reason is it's been dry years for a long time in uranium capital markets. And what you don't really want is a capital structure that's about to enlarge itself significantly because management is finally in a position where they can raise reasonable money and they're not going to let the opportunity go. So ideally an advanced asset that doesn't need a lot of money spent on it to be ready for production. Finally, low non-financial risk. Now this is vitally important in our sector when you start looking at what's available on the ASX and TSX. You don't want to pick a horse, see the sector do what you'd expected, hoped and dreamed it would, and then find some sort of extraneous risk has held back your horse from running the race. And you don't want to see it all the way up and all the way down. You want a management team and a leadership team that will deliver shareholder value as we see the market come on. So again, really happy to discuss and debate whether these are the most important 6 or if you'd add anything to, but I reckon that this is how, as an equities investor, we can play this bull market. And if we look at a company like Bannerman, we've moulded the company and ensured that the company is perfectly positioned across those 6 criteria. So first of all, track record. We've been focused on uranium and uranium only since 2006. We are literally one of the last men standing in this sector. Deep sector experience, got more than 100 years of uranium experience in the board of the Exco. And as Sam said at the front of the call, I'm sort of moving in the right circles at the moment. We've got a very good nuclear industry profile. We know Namibia really, really well. I lived there for 5 years or more. And importantly, we've got a history of institutional support. So when institutions start coming back into this sector, for a stock like Bannerman, the only things that are missing for them is market cap and liquidity, and they will be automatically fixed by the market picking up. We've had all of these instos on our register. We've still got an institutional grade board and corporate governance and all of that type of thing. So the welcome mat's basically out there for instos when we hit the market cap that they can come into us. And finally, we've got established credibility and leverage. So that's a nice way of saying people still remember that we were the market darling last time. To put it another way, the taxi drivers still remember our name. And that's why. So that is our share price during the last uranium boom. And that little flat bit at the beginning is because the company took a little bit of time to acquire the Etango project. And the peak enterprise value, we didn't have as much paper on issue back then, it was only 137 million shares, but all the same, the peak enterprise value back then was $522 million, compared with 42 million now. And interestingly, that's about what our published DFS NPV is, which I'll come on to later. So it's not wild or fanciful thinking that if we see another bull market like we saw last time, that we could be back at those sort of levels. Leverage to price. So I look at leverage in one of two ways. The first one is what sort of leverage do we have in the ground? So in other words, as we see a market switch from a downswing to an upswing, people and investors and companies and the sector starts to value what you've actually got in the ground. The last few years, there's been a surplus of uranium. No one's really cared about what you've got in the ground because the people who are taking it out of the ground are losing money. So as you can see from that comps, if you compare our enterprise value to both resources and reserves, we are extremely favourable compared to the rest of the market. And as you can see, not many of our peers have got reserves because their projects aren't sufficiently advanced. So I expect as we switch into a bull market and there's more of a focus on different metrics to value a company, we can expect to be re-rated significantly just because of the sheer and enormous volume of our resource base. This is a slide you might have seen before. That is our sensitivity curve to uranium price under our DFS. So we've got post-tax NPV running up the x-axis on the left and uranium price along the bottom there. That is the DFS update work that we've been doing over the last 12 months. In other words, that is the value accretion, the NPV accretion range that we would hope to achieve once we've incorporated the various processing and technological optimization that we're engaged with right now. In simple terms, if we were to plug in the term price from the last boom, which was $95 a pound, we've got a NPV value in excess of $1 billion. And if we were to plug in the spot price, the base spot price of $110 a pound, we've got an NPV well in excess of $2 billion. And you can see the current market capitalisation right down the bottom there. So very, very significant valuation leverage to a recovery in this sector, and enormous leverage if we see an overshoot. Strategic appeal. That is all of the world's uranium mines or projects, and that's a tango there in the orange. So we're up there with the big boys to start with. If we first of all isolate just the development projects, so we've taken out the operating mines there. Now let's look at those projects that are not owned by a major or a state-owned enterprise. So I call that the unaligned projects. So these are the projects that we have unaligned at the moment, and you can see that we're the second largest in the world. This is an important slide because as we see the sector recover, and we know from other sectors in this industry that there will come a round of consolidations. For a major looking to get bigger than the other majors, or a mid-tier looking to become major, or a state-owned enterprise looking to ensure that they've got the uranium for their nuclear build, anyone looking for a project in this sector, that is a very, very small shopping list to go to, and we're the second largest. And if one of those groups decides that they needed the certainty and the reassurance of a DFS before making that type of a consolidation decision, that's their shopping list at that point. So you can see that we're by far the largest unaligned project in the world that's got a DFS. We talked about advanced asset. I think I can just show it very briefly here. That's moving from left to right. You're seeing, say, PEA or scoping study moving through PFS, then to DFS, and then finally to a pilot plant or some sort of trial mining. You can see Salamanca that's in construction, and then a Tango is right at the gate ready to go. So you can effectively call it shovel ready. So finally, low non-financial risks. As I said, you don't want to back a horse and find out there's something else about it that means it stands still as the rest of the party carries on around it. We're permitted. We've got a retention licence, which is the best form of tenure that we can have at the moment because it gives us tenure security with flexibility and no obligations. We've got environmental and social permitting in place. It's a very simple operation. There's a huge volume of technical work that's been done, so we know it's low risk, and we've run a pilot plant for 2 years just to put it beyond all doubt in the minds of financiers. Now here's the thing, at a 40 million market cap where we are at the moment, I would contend that it's got a huge value backing to it. It's not cash backed, but there's a lot of value backing. So for $40 million, you couldn't actually do the 360,000 metres of drilling that we've got into this project. there's a huge volume of technical work that would be extremely expensive to repeat, not to mention the time cost of it. We've got a demonstration plant that sits there that will be an asset to the mine as we go on, and we've got this enormous resource base. So I would say we've got an exceptionally asymmetrical value proposition. We've got enormous value upside because of the leverage to a uranium price recovery. So the risk is financial risk, the risk is uranium risk. But the downside risk, because of this value backing to the stock and the fact that the market has already downrated us so severely during the bear market, I would say there's relatively very low downside risk in this stock. And that chart there, that is our share price since Fukushima. So the night before Fukushima happened, we were trading at 78 cents, and we've come all the way down to 4.6 where we are today. We're in Namibia, so again, in terms of non-financial risks, this is very important. You don't want to find that a political decision all of a sudden takes your rug from under you. There's a whole range of reasons why Namibia is a fantastic and really the premier uranium development destination. That map just shows you that all of the infrastructure that we need to build a mine is in place, including desalination, deep water, class 7 port, road, rail, power, water, etc. So we just need to plug in, we just need to join into the existing infrastructure. And then finally, leadership that can deliver. So in terms of ensuring that we don't ride it all the way up and ride it all the way down, our chairman's an investment banker, I'm a mergers and acquisitions lawyer, and our chairman in Namibia ran the world's largest uranium mine, the Rossing uranium mine in its day. So if we stick all that together, we've got a sector that's moving from a decade-long surplus, a decade-long deep bear market, into a deficit and into a deep deficit. That deficit is very substantial, potentially 20% supply disruption in the next 6 to 12 weeks, in the context of a number of forward indicators showing growing demand and a sector famed for its bull markets. And I would contend that Bannerman's your number one horse to ride in this environment because it's got a long history in the sector, it's got significant price leverage to a uranium price recovery, it's a strategic asset, it's advanced, there's very little extraneous or non-financial risk, and I can assure you that the leadership will deliver.